Hello, financial freedom fighters. John Thorman here, and I'm really excited to continue our series on this tax-free retirement plan and educating you on how these work and why I think you should look at them and include them in your mix of retirement funds. And last week, we talked about the four attributes or the four characteristics of the perfect retirement plan, and they were: one, we wanted the money to be tax-free; two, we wanted good growth rates; three, we want zero risk of loss; and four, we want liquidity. When I ask people what they feel the four attributes or four characteristics are of the perfect retirement, those are the four that I get all the time. And so we're going to run through them. Last week was on the tax-free part. Today we're talking about good growth rates. We all want to earn money. We all want to earn good growth rates on the money. And I'm excited to tell you that in these tax-free retirement plans, we are not giving up growth. We are growing our money safely and in a way that lets you sleep at night, because we're not taking on crazy speculation. We're not having these roller coasters, this yo-yo effect of your money, but rather we're consistently growing it up and sideways over time. We're not incurring losses, and that is critically important and a big distinction with these tax-free retirement plans. So it's interesting. I referred to it a little bit as your FedEx money. Maybe you'll recall before FedEx, it was called Federal Express. And in the late 70s and early 80s, they had a very successful advertising campaign that went something to the effect: when it absolutely, positively has to be there overnight, you choose FedEx. So I think your retirement money is the same way. It absolutely, positively has to be there when you retire, so you cannot take on excessive risk. You cannot put all of your money into the stock market because it's more like a casino right now. It's more like gambling and not sound investing, and you just cannot do that with the money that has to be there. Sure, you can have 10% of your portfolio maybe in something speculative, take some risk, have some fun, try to run up the numbers, but not with the money that absolutely, positively has to be there for retirement. That's not. We don't gamble with that money. We've got to be more I don't know what's the word, but more responsible, more secure with that money, but without giving up growth rates. And that gets to one of these money myths that I want to shatter. We frequently are told that if you want big returns, you need to take on big risk. Well, that's only in a scenario or a world if you also suffer big losses. Because if you suffer big losses, then you have to have huge returns to compensate and make up for it. Well, in our tax-free retirement plan, what we're talking about is a way to grow your money over time without incurring any losses. There's a floor, there's a minimum return that will not go down below zero, so you'll never lose money. When you are in a position where you don't lose money, then you don't have to chase these super high returns to try to compensate and make up for these dramatic losses that you just suffered. Okay? And here's the point. I mean, Warren Buffett nailed it on the head. He talks about his 2 rules for investing. Maybe you've heard them before. Rule number 1 from Warren Buffett when it comes to investing is never lose money. And rule number 2 is never forget rule number 1. You do not want to lose money. And if you can eliminate the losses, okay, then you don't have to be chasing super high gains to catch up. So with the tax-free retirement plan, no heartburn, because you don't lose, lots of money, and so then you don't have to have these crazy years to try to catch up for it. All right? If we take a look at Dalbar's 2020 quantitative analysis of investor behavior, they've been analyzing investors and investor returns for decades now. And if we take a look at this latest report of theirs and take a look at it. If you consider yourself an average investor, right? Maybe you're putting money away in a 401k plan currently. The average investor, according to this report, over a 20-year period of time, earned 4.25% a year average annual returns. Only 4.25%. That's the average investor. The S&P 500, using that index, okay, as our benchmark, the S&P 500 over the same 20-year period earned 6.06% a year return. That's not shooting the lights out, right? And that's because it considers the years where you lost so much money. Okay? If you look at the last 12 months, it was great. You know, the S&P 500 was up 31.49%. The last 3 years, the S&P was up 15.27%. But over the last 20 years, 6.06%. So I'm super excited to tell you that these tax-free retirement plans that are available today, we're seeing 20-year returns of over 7%. We're seeing solid returns that are beating the market, that are beating the average equity fund investor because they're not losing money. Here's a great example. You can see this chart. If you were to invest $100,000 back in the year 2000 in the S&P 500, which is the yellow line, or $100,000 in an indexed account with a cap of 11% and a floor of 0, over the 20 years, because the index account never lost money, it way outperformed the S&P 500. I mean, that's fantastic. That's just 20 years. Right? You could save money for 20 or 30 years to get to retirement, but then you got to live through retirement another 20 or 30 years, right? So that money's got to keep working for you. So, yeah, real quick, $100,000 invested in the year 2000 in the S&P 500, after 20 years, net $219,000, give or take. In our index account, $325,000. The $325,000 never had a negative year, never lost money. It just went sideways or it went up, sideways and up, sideways and up, 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 up. So that's a dramatic improvement over investing in the market. So I want to just offer some encouragement. We're looking to grow people's money. We want compounding effect of money over time. We've got to put it to work. But by eliminating the losses, we will outperform the market because we don't have to catch up. We're not in the hole for 5 years or 10 years trying to make up for all that lost time. So we can really outperform the market over the long run by not losing money. And that's what, this is all about, right? How do you get financially free? Well, you've got to have assets that can pay you that passive income, right? Assets that can kick off cash so that you don't have to work to earn your money anymore. And one of the ways to do that is by building up investment portfolio or cash that is going to then make you a monthly check or an annual income without having to work. And these tax-free retirement plans, not only do we benefit from accumulating money that you'll never have to pay taxes on, which could save you like 50%, right? I mean, it's going to be dramatic, I think, in the future, but we don't have to sacrifice growth. These tax-free retirement plans are earning really good rates of return over the long run and can rival, the index. They can rival the S&P 500, which is kind of the benchmark. So I'm super excited about that. In the next video, we'll take a look at the number 3 issue on the top 4 attributes of the perfect retirement plan. If you like this, just, give me a thumbs up, subscribe to the channel, share this, ask questions, drop it in the comment sections below. But look forward to working with you and helping you fight for your financial freedom. You can do this. Talk to you later.